looking out further, not looking at quarterly ups and downs.
Governor Patrick Cummins from the Australian newspaper. Now, the government's revamped stage 3 tax cuts look like they were passed, so they were introduced today, they look like they were passed. So the question is, given the beneficiaries of the tax cuts, or the bigger tax cuts will be lower middle income earners, and then who tend to spend more of these bigger tax cuts, how much will that add to demand, to spending, and inflation?
So I think the very short answer to that is I don't think it's a material issue. If you look at Treasury's analysis, which was published on the website, they actually did a little bit of analysis to look at what might happen depending on different marginal propensities consumed. It's very at the margin. The bottom line really is that the fiscal envelope is the same. It's the same amount of money being handed to the households. It's distributed slightly differently, but we don't think it has any implications for our forecasts.
Governor Peter Ryan from the ABC. Given what we're seeing in the revised forecast in the quarterly statement on monetary policy, softer GDP, inflation slowing faster than expected, the jobless rate ticking higher, was it a mistake by the RBA board to raise the cash rate in November, and have you overdone the rate rises?
Thank you, Peter. The short answer is that we didn't make a mistake. That was based on, all of this is based on risk and risk management framework in some sense. What we're doing here is we're trying to balance bringing inflation down versus keeping the employment gains of the pandemic that we made, which has been great. At the same time, we don't want inflationary expectations to rise, which would make the job harder and ultimately be more costly. So on that basis, the raise in November, the risks had shifted to the upside, and in order to mitigate some of those, to give a bit more assurance, that was the appropriate move at the time. I don't need to remind you, probably, you'd know this, that we haven't gone up as far as other countries have gone up. And because we are trying very hard to make sure that we bring this balance in terms of the employment and the inflation objectives.
Today that you're not going to rule out any further tax cuts. Terrified many Australians.
Tax cuts or
sorry.
It's your time to shine.
I know.
I would have a situation where people are going to be terribly nervous about that announcement today. We have been told by economists that we could expect up to 3 cuts by the end of the year. Are you saying that is now completely ruled out? And is there a danger that if you don't act, that if we see unemployment numbers continue to rise, retail sales keep falling?
Good question.
It gets away from it. You start to spiral down.
As I said earlier, we haven't ruled anything out and we haven't ruled anything in. So I would say we have maintained the option that it might be that there has to be more rate rise, but there might not be either. Nothing's in, nothing's out. The optionality here really needs to be maintained because we need to be driven by the data. And I'd come back to the point that I made earlier. I really understand that the mortgage holders are sweating on this. I do understand that. But the big issue that's confronting not just mortgage holders, but everyone, is inflation. And the fact that inflation is so high in so many parts of their lives at the moment is really what's hurting them. So what's really important here is that we address that issue for people. That will help mortgage holders. I know that they're doing it tough, but it will also help renters, for example, who don't have mortgages and also are experiencing these inflationary pulses. So in the end, I think that's why we need to stay the course.
Chris Colin from Nine News. Thank you for this. Looking at the forecasts, Australians could be beginning to thinking that there will be up to 2 interest rate cuts this year. As you said, mortgage holders are hoping for that. What do you say to them?
So if you look at the forecast, the point I'd make about the forecast is that there is a cash rate assumption in the forecast, and there has to be. We need some sort of assumption to work with it. But I emphasise the word assumption. It isn't a commitment, it isn't a forecast, it isn't even an expectation. It's something to work with. As we move out with our forecast, it gets more uncertain. And It might be, we've already emphasised that there could be risks on the upside, there could be risks on the downside. Now, if the risks on the downside present themselves, then we have the options of cutting interest rates. If the risks on the upside eventuate, then we might have to look at whether or not we need to increase again. But I think the point is that we need to make sure that we don't have to backtrack on inflation, that inflation doesn't get away. We do need to make sure we're making progress. We need to convince that that progress is going to continue. That's what's going to help ultimately mortgage holders and everyone.
Hi, Governor. Stella Chiu from Reuters. I just have a question about, so on a scale of 1 to 10, how confidently are you currently about inflation is moving sustainably back to target range? And just what will make you more confident?
So once
That's a high school question now.
Am I about inflation?
From 1 to 10.
In the band. Well, if you looked at our forecast, I guess, and thought that's our central forecast, 0.5. Or 5, sorry, 5, 1 to 10. Look, I'm confident. I think that the signs are that my predecessor used to talk about the narrow path. I feel that we are potentially on that narrow path, but I also feel that we need to just remain very alert to the risks on both sides. But as I said earlier, if inflation does not move back into target within a reasonable time, and if it's still well above our target band in a few years' time, that will not be good for inflation expectations, and ultimately it will not be good for the economy. So I think the signs are good, but we've got to be very vigilant.
Governor Shane Rupp from the Age and the Sydney Morning Herald. Taylor Swift inflation hit my family again last night.
Jesus, man.
When my daughters tapped the bank of mum and dad to pay for some newly announced releases. Is the huge interest in Miss Swift, who's about to have our thoughts?
Oh my God, this is embarrassing, man.
Services inflation that you've mentioned quite often through the statement of monetary policy, and how do you stop, or how does interest rate rises affect services inflation, be it insurance, legal fees, or Taylor Swift tickets?
Yes, I know all about Taylor Swift inflation as well myself. I think the bottom line on services. We're talking to colleagues about what services inflation is, because I think people don't quite really get what it is. And one of my colleagues said services inflation is anything that you can't drop on your foot, right? So all of these sorts of things you're talking about. Monetary policy, it's true, works on the demand side. And to the extent that some of these things you're talking about, like insurance and electricity and these sorts of things that are being driven by other things, monetary policy doesn't directly impact that. But it can indirectly impact, because these sorts of costs go into businesses' costs, obviously, non-labour costs. And to the extent that demand is tempered, it tempers the ability of them to pass on costs. So this is the way that you can end up with an indirect impact of monetary policy on these sorts of services.
Yeah, probably not.
On Taylor Swift tickets, I'd say that from my own experience is that my kids put money away to do it. They forewent other things in order to be able to afford
$600 just for tickets.
So
Jesus, how
I
much are
think
you
there's
making?
also issues people are deciding what's really important to them and
It's
what's
been on
not.
7 trillion over the
Really,
equivalent
a lot of
period last
people,
year.
Taylor Swift is very important.
Governor John Roth from the Daily Telegraph. As usual on a first Tuesday of the month, I'm confused. I'm wondering, are you telling us that the central forecast of the central bank is for 2 rate cuts this year, or are you saying that rates could go up? The US Federal Reserve has been explicit in offering guidance of 3 rate cuts this year, or is it simply the case the Reserve Bank has no idea where it's going?
So in the forecast, as I said earlier, they're assumptions of a cash rate. They're not the forecast. They're not an expectation. They're an assumption that we need in order to generate a forecast. And as you can see in the statement on monetary policy, the further you get out, the bigger the range of uncertainty that is around those. So although the central forecast is for inflation to get down there, that's not necessarily where it's going to be. And it's only as you get closer that we're going to be able to narrow down the bands of uncertainty and get more certain, and then we can make decisions about interest rates. So I don't want people to get confused about the assumptions in there about this is somehow the path that the Reserve Bank will follow. It's not necessarily, it's not an expectation, it's not a commitment, it's a technical assumption.
But how can the US Federal Reserve be so much more confident? Do they have better computers than you?
No, the Federal Reserve, I think, are in a different position to us. So if you look at, we are setting monetary policy based on Australian conditions, and if you go back, the Federal Reserve have a situation where they have put interest rates up much further, they've got a stronger economy, they've got inflation coming down in other ways for different reasons than we have. So they're setting according to theirs, and we're setting according to ours. Their pause and their guidance is based on what they think is happening to their economy. They're not always going to be certain, and I would hazard a guess that if you went back a couple of years and you looked at what their dot plots said, for example, the dot plots will look quite different now. They're not the same.
A bit of
So
China news actually coming out, which is probably causing this drive.
They just put things
Taking out
out
those
there
4-hour
in
supports.
dot plots, which we don't
Giving us
put out.
a bit of almost an official lower high. Same way again, back down here is where you want to see it.
But that's not a forecast. That is not a forecast of where we think interest rates will go.
Copper. Moving up a little.
David Charles from ABC News. So my question is, what's keeping you up at night, and what are the biggest risks on the horizon that might cause you and your colleagues to lift interest rates again, since you haven't ruled out that possibility?
Yeah. Well, I'd like to say nothing keeps me up at night, but that wouldn't be true. Look, what worries me, I think, most is that we don't manage to bring inflation back down to target without collateral damage, if you like, with more damage in the labour market than we can avoid. I really, really am convinced, and the board is convinced too, that we can manage this. The risks on the upside, there are risks on the upside which are sitting out there. There's still supply side issues going on at the moment. And although traditionally we would think we would look through supply side issues, sometimes if it gets entrenched in people's expectations, you can't entirely look through. So I think the thing that worries me is that we get some more shocks. We don't know where they're coming from. You look at the last few years, pandemic, Ukraine, Middle East, what's going to come from left field? That's what worries me. What I don't know is coming and what the implications of that might be for inflation and inflation expectations, and how do we handle it?
Governor James Glynn from the Wall Street Journal and Dow Jones. I'm just going to flip things a little bit on the head. Everyone's talking about rate cuts. Is it the case that another rate hike is a bigger probability than everyone's betting, including the markets and economists? I mean, we're looking out. We're talking about the services side. We've got rents, electricity, insurance. These are parts of the economy where prices are rising and interest rates can't really affect too much. The budget's coming. The base wage increase is on the horizon. And we all know the government is in favour of a high-wage economy. They haven't mentioned the tax cuts, the Red Sea, and a bunch of other things. But is it the case that people are sharply underestimating the prospect that the next move in interest rates will be up?
I think, James, we judge things, the risks actually at the moment is fairly balanced. So I'll come back to my previous point that we're not ruling in or out interest rate changes.
Sitting on the fence.
The board decided today to stay on hold, given all the evidence it had. There was encouraging signs that the forecasts indicate, so that in the central forecast we are coming down around about to targeting 2025 and then midpoint 2026, and the judgment that risks are broadly balanced. So that's, I think, the way I would characterise it.
Governor Edward Boyd at Sky News. Look, today's the new day of doing things at the Reserve Bank, the two-day board meeting, the press conference. Firstly, how did the new format of the meeting go? And was there a bit of pressure in the boardroom today, knowing you've now got a 6-week break until the next cash rate call? Is there a bit more pressure there, knowing there's more time in between these rates decisions?
It went well, thank you very much. It's amazing that you give people more time and more discussion. So there was no shortage of things to talk about, and I think that it went well. I think there was, the review talked about more time for in-depth discussions. I think that's borne out. I think we got that. I also think that the board are conscious they're meeting less often, but I think that gives them a bit more opportunity to think a bit more broadly rather than meeting to meeting, to think a bit more about strategy, and I think we saw that borne out today as well. So I'm happy with the way things went.
Thanks, Governor. Rachel Clun from the Sydney Morning Herald and The Age. You said services inflation can be indirectly impacted by monetary policy, but for something like insurance, which everyone kind of has to have, how much impact can you have and what else could be done about that?
Well, the insurance sector's got its own issues going on, and there's not a lot that monetary policy can do about that. So we only have our tool. Insurance costs and the way insurance is moving in relation to climate change, in relation to the effect on premiums and profit margin rebuilding, reinsurance costs. These are things monetary policy can't do anything about. So that's much more a matter for government.
Thank you, Governor. Peter Allen from The Guardian. Just 2 questions. You do mention that inflation hurts, but so does joblessness. And so I'm still wondering when, because you talk mostly about the inflation risks, but what will it take in terms of rising unemployment for that to get, say, priority interest from the RBA? And also, you do say that inflation is going to fall, but in December it was 3.4 year on year. So the RBA did underestimate how far inflation was going to fall for 2023. It came in at 4.1 instead of 4.5 that you forecast in November. So is there a possibility that you might also underestimate how far inflation might drop?
Well, I'll take the second question first. It's true that that was lower than our forecast for that we had in November. That was goods price inflation. Services inflation pretty much came on where we thought it would. So really the surprise in goods price inflation, I think, is the main point there, and it doesn't alter our view that services is actually underlying a lot of the and evidence of some still underlying demand strength in the economy. Now, sorry, I've forgotten the first question was.
You said that inflation hurts, but so is
unemployment. Yes, yeah. Yes, and we talked about that in the statement actually, but and in the new statement on the conduct of monetary policy, the board has agreed with the government for employment, which basically means employment which is consistent with inflation sustainably in the band. The board is very conscious of that, and that gets a lot of attention in board meetings. We're very conscious that employment is very important for people. It's important for them meeting their financial obligations, obviously. It's important for good mental health reasons and so on. So it gets a lot of consideration. The point I would make, and this is in the forecast as well, is that we still have employment growing. We want employment to continue growing. Mechanically, what happens though is if we slow growth in employment, because we do still feel that there's tightness in the labour market, it's a little bit over tight, it's eased, but a little bit over tight. Slowing the growth in employment, so it's not quite keeping up with the labour force mechanically, that moves into a rise in the unemployment rate. But employment is still growing, job opportunities are still growing. And that I think is the balance we are trying to achieve. That's really what we're aiming at. And the board, I can assure you, is very, very focused on that.
Thank you, Governor. Jack Quayle from News Corp Wire. Wage growth has been revised higher in the forecasts in the near term. I mean, what's the risk to the economy if we don't see uptick in productivity in the near term with those higher wage growth forecasts?
Yeah. So I think a few quarters of higher wage growth isn't necessarily an issue. And we've actually seen that some of the uptick very recently has in fact reflected the wage case, an uptick in award wages. So we're expecting that, we've flowed that through to the forecasts. but from a liaison and from other sort of sources, we are seeing that in some sectors, wages growth is starting to ease off a bit. But again, as demand impacts, as monetary policy, which is, we think is restrictive, it's impacting the economy, it's impacting demand, that will start to ease labour demand and that will start to ease wage increases. So is it a risk? Possibly, but we think at the moment that it's a reasonably balanced risk. We think that the signs are in the right direction.
Given that the Reserve Bank has the target of 2 to 3% for inflation, how far into that range would you want to see inflation reach before you'd be willing to move, or is near enough good enough to the range given the risk of recession?
So that's the range. The new statement on the conduct of monetary policy says we should be aiming for the midpoint of the range. So that's sort of ideally where we want to be, because if you're sort of at the top or the bottom, the risks of being pushed out obviously are higher. Would we need to wait for it to be in the range? Absolutely. I think that's a question that remains to be seen. What we need to be convinced is that it's moved enough and we're convinced that it's going to get there and it's going to be sustainably staying there. So I can't give you a timeline on that, but as I said earlier, we're data dependent. We're watching the data, we're watching the impact on demand. Demand, we assess, is still a little bit higher than the ability of the economy to supply the services and goods that people are demanding, but it is coming off. And we're confident, as we said, our central forecast is that we will get there. And if we're getting there and we look to be on track to get sustainably in the band, then we might be able to think about interest rate cuts, but we've got to be confident about that.
From the Financial Times, just a non-domestic question. China is mentioned as a risk factor, specifically a prolonged cyclical downturn. I wonder if that is built into the GDP forecast at this stage, given it's mentioned a few times, and obviously a clear risk, and what impact would that have on the housing market?
Yeah. So China, yes, the slowdown in China is built into our forecast. As we all know, they are experiencing difficulties, particularly in their property sector. There has been some policy response to slowdown in China GDP, but it's still a slowdown. The way that impacts us, of course, is through commodity prices in particular and our exports of commodities. So we are very focused on it. We've got a slowdown built in to our forecast. We've got what's there at the moment, and obviously if circumstances change in China, then we'll have to relook at our forecast. But at the moment, I think we're comfortable that we've got something built in there which is realistic for China.
Governor Deb Knight from Nine Radio, you say that you and the board have an understanding of how Australians are hurting, but how have you come to that understanding? Because it's all good and well to sit in a boardroom, but are you speaking directly to people who are struggling to pay their bills, to people who have had their homes repossessed, to businesses that have had to shut up shop? And what are you saying to those people who really are hurting?
So there's a number of ways in which we're in touch. We have a business liaison program where we go out and we talk to lots and lots of businesses, small, large. We also talk to community organisations. We talk to organisations like ACOS, Beyond Blue, various those sorts of organisations. I can assure you I get lots and lots of letters from the public and I read those letters and I understand those issues. The challenge for the board is that we have one instrument that works in aggregate and it impacts demand and it does have distributional issues because interest rates affect different people in different ways. But I come back to the point that what's really hurting people at the moment, the really big thing is inflation. You know, grocery prices increased by 20% over the last 2 years. That's massive. And that's really hurting people, particularly people on low incomes. And that's why I know it's really hard for people to understand this when they're being impacted by interest rate rises, but the alternative is much, much worse. And if we can just get inflation down, then that will benefit everyone and interest rates can come back to a more
short-term pain.
That's the critical thing.
Rates high for longer.
Hi, Governor. John Keogh here from the Australian Financial Review. Just on the new arrangements with the board that kicked off over the last couple of days, was it a unanimous decision? Was it actually an improvement, and if so, how, for new processes? And some people are out there saying that there's going to be a lot more noise here to deal with various board members appearing in public, maybe giving speeches, maybe appearing publicly somewhere else. What do you say to that?
So we're still under the old board processes at the moment. The new board processes with unattributed votes and board members sort of having public appearances, that doesn't start until the new monetary policy board comes into place, and if the legislation goes through, that's expected to be 1 July this year. So, but having said that, we have already changed our processes a little bit, as you say, the 2-day meeting, and I think I answered earlier that I thought it was really good. I thought we weren't as time constrained. We did have time to let conversations go on and debate across the board table to go on. So I thought that actually was a success. The other thing I would draw your attention to, maybe you noticed it, maybe you didn't, but the statement on monetary policy looks different. I hope what it is more accessible and plain speaking, and drawing people's attention to what's important, what the board thinks is important, what the bank thinks is important, much more readily, so that people hopefully can use that much more readily to understand where we're coming from. So I think that's one part of the process, but there's more to come.
Tom Dewsbury from the Australian Governor. Following on from the statement, the quarterly statement on monetary policy, there was a fair bit of discussion on unit labour costs there. Overnight, we've had the OECD basically saying with core inflation elevated around the world, it notes that the growth in unit labour costs is compatible with return of inflation to target. Is that something that worries you, that the big inflation that started in 2021 may not end in 2025 because of unit labour costs?
And it's related to an earlier question on productivity. We've talked about this for a little while. Unit labour costs have increased quite a lot, 7 or 8%, I think, in Australia, and overseas have seen similar sorts of increases. And it's unit labour costs obviously that are important for businesses because it's the cost of producing an extra bit of output, obviously, and if they're rising by that much, that's what's going into their cost base. So that's why productivity is important to that. Now, as I said earlier, it's been difficult to get a read on productivity in recent times. The pandemic has thrown things out a bit. We are assuming in our forecast that productivity does go back to something which is more normal, and that's going to be very important for bringing unit labour costs down, increasing unit labour costs down to a level that's more consistent with inflation running at about 2 to 3%. So, bang on the money, that's what's important. We're confident that there are reasons to think that productivity will start to pick up, but again, don't get too hung up on the individual quarterly machinations. But ultimately, I'd like to be able to look back in a couple of years' time and say, yes, we're now seeing productivity resume its normal trend.
Governor Eric Johnson with the Australian.
Geez, how long's this press conference going for?
A couple of state premiers
I get it's their first time, but
just wondering if you have a message for them, particularly as they're thinking about their own state budgets.
Yeah. So they've got their tools, we've got our tool.
buzzwords.
The thing I would say about governments generally, not just state governments, is that they have a very challenging balancing act. They have got a lot of issues to address, and they've got to use their expenditure and their revenues in order to address those. So I'm not going to tell them how to do that. They're best placed to figure out how to do that. The other point I would make is that one of the things that's really important for the growth in the economy is having a capital stock and an infrastructure that supports growth. And many of the things that governments do is all about infrastructure, and it's about health and it's education and it's transport and so on. So this is their challenge. They've got to, on the one hand, deliver these things, but they've also got to be mindful of their impacts on their spending and so on. And so, I have no message for them, but I think they've got, they do have a challenge, and we will work with what we've got, and they can work with what they've got.
one sort of extending on from that one, that we do have a federal budget coming up in a few months. Are you worried that if it's a big spending budget that might have an impact on inflation risk? And secondly, as you've sort of heard from some of my colleagues here, markets obviously don't really believe that we're not going to have a cut anytime soon, and mainstream economists and some of the commentary seems to suggest the same. Does the RBA have a credibility issue? You've said repeatedly this is about the data. Why don't they believe you?
So let me take the first question. I'd say that at the moment the government are keenly aware of inflation, and I know that when the stage 3 tax changes were announced, the government was very conscious of inflation, and the point that they kept the changes within the fiscal envelope indicate to me that they've got that at top of mind. But as I said earlier, they've got a lot of things to balance here. On the markets, I don't think we have a credibility issue here. I think generally the markets think we're serious about inflation, because we are. We've said it a number of times. The markets will jump at little things. I know they sort of go through the statement and they try to figure out exactly what little word changed where and how that might mean, but I think sometimes they're looking for tiny little subtle things that may not be there, but I don't think it reflects on our credibility.
Governor Huntsley of Low-Wire Markets, thank you for today. Combining today's decision to hold rates and the assumptions around the cash rate, and I know you don't want to rule anything in or out, but combining both those things together, does it suggest that monetary policy is restrictive enough? And how much risk is there that you may be forced back into tightening mode over the coming months?
So I think the evidence is that that monetary policy is restrictive, it is working, and we see that in a number of things. We see it in inflation is coming down. We see it in the fact that the labour market is easing. We see it, I think, in the fact that just generally, I think, households are saying we're curbing our consumption, we're focusing on essentials rather than things that you can do without. Anyway, so I think the evidence is it is restrictive. And I think the challenge for us is that is it restrictive enough to bring inflation back down within a reasonable period, that means that inflation expectations don't get out of hand. We think we're on that path. That's our central forecast, but we're alert to things that might go either direction. That's the message.
Hi, Governor. Dan from M&A. Just wanted to know if there's going to be any future clarification on assumptions around the Nauru and the neutral rate in the future.
So both unknown variables. On the Nauru, that's a very technical term. We put out a chapter in the Statement on Monetary Policy today which talked at length about the way we try to think about full employment. And it's not about a single number, it's not about a Nauru, it's about a range of indicators that give us a feeling for how close or how far we are from full employment. So I would like to step back from focusing on specific numbers in this case. Similarly to the neutral rate, it's not observable, we can't deal with it in real time. But we observe what's going on in the economy, and that's what gives us a feeling for whether or not we're restrictive or not, whether we think we're above the neutral rate or not. So I think people can get a little too focused on individual specific numbers. It's a lot more judgment than that. Okay. Oh, one more.
Michael Pascoe, New Daily, Lucky Last. I'll make it a segue to Peter Howard, really. The statement says basically you're comfortable with the present rate of wage rises, it's consistent with the target. That's at an unemployment rate of 3.8%. Implied in the forecast, you think full employment is 4.4%. That's what will get you to the target. The statement also admits that really it's possible you're already there at full employment. Does the bank have any idea what full employment actually is? will you ever know it until after you've gone past it and done damage?
It's sort of a little bit the answer to the question there. There's no single number here that we're focusing on. We still think the indicators are that there is tightness in the labour market, and there are pockets of tightness, there are pockets of wage rises that are still quite strong. There are pockets that aren't. So there's still indications that there's tightness. We're still hearing from businesses that some of them are finding it hard to get staff. It's easier than it was, but it's still a little bit harder. So there's all these sorts of things we're putting into the mix together. And I would again discourage you from saying just because the number says 4.4 in the forecast, that's what we think full employment is. So it's much more difficult than that, and it's much more a judgment call.
You have an idea of what full employment is?
We have an idea that full employment is where we've got employment at a level, unemployment at a level that inflation is low and stable in the band. That's what delivers that's full employment in our language. Sustainable full employment. That's what we think of it as. And we only know that by looking at the financial indicators, the economic indicators around it, again, the data. Thank you.
And so you might already be there.
She'd say that if she was. All right, so yeah, not giving away a great deal there. Like my sort of feeling with this is that yeah, I mean it's a lot of the buzzwords were sort of thrown around.
Into a higher security building, and I didn't know.
So ticking on here. There's a lot of yeah buzzwords that have been thrown around. So using our tools and job still needs to be done. These kind of things, but I think sort of the fact that it's quite clear that we're not at the target that they want to see it at. Given the right sort of like data coming out, like if we see CPI sort of flatten out a little bit, I think that's definitely sort of saying that it's still on the cards that we're going to be sort of hiking. And while there's still an expectation of hikes, that possibility of hikes, well, you're obviously not going to be seeing the cuts. And particularly seeing that sort of like, you're seeing other economies sort of like Fed and that sort of holding off on things at the moment. We're always lagging a couple of months behind them. So I wouldn't be sort of counting on any sort of cuts anytime soon. I mean, at best at the moment seems to be sort of like holding Aussie just up in this little zone. But the here and now short term, we've just come up, as I said, this is where the sellers are, and we can see that the buyers are around the zone previously. So this is still the line to beat, and as you can see, it's pushing up into this area here now. We've got a little bit of a negative divergence. I think this is on the, what was this one on? Yeah, on the 1 hour. So negative divergence, particularly on a 1 hour, is good if you catch it around this zone here. Once it's moved up here, the kind of move's already exhausted out with it all. So it's not like a necessarily big, massive turnaround sort of signal if it's just on the 1 hour, 4 hours and above at least, to sort of see some sort of continued sort of trend change with it all. But as you can see here, we're sort of hitting back, we're selling back from where we expect it to be. We're just at the mercy of whatever they want to do with the US dollar. Like that's not about to sort of necessarily crash. So it's going to keep us trading pretty heavy for a little while longer. But certainly in the short term, if we can get a break and a close up above this sort of 65.20 area, look for a little back test, take out that breakout candle. That gives us a couple of little areas that we can look to aim for around the 65.50, 65.60 area in the short term. All right, that's about it from me.